Hi and welcome to the Financial Sigma. Let's start with understanding what a credit score is. A credit score is a 3-digit number that is calculated based on your credit history. It is used by lenders, landlords, and other financial institutions to evaluate your creditworthiness, which is a measure of your ability to pay back debts on time. Now, let's talk about how to improve your credit score. Here are some steps you can take. Pay your bills on time. Payment history is one of the biggest factors that goes into your credit score, so make sure to pay all your bills on time. Late payments can have a negative impact on your credit score. The more late payments you have, the lower your credit score will be. Payment history accounts for about 35% of your credit score, so it's one of the most important factors. It's important to pay all your bills on time, not just your credit card bills. Late payments on bills such as rent, utilities, and even gym memberships can also be reported to the credit bureau and have an impact on your credit score. If you're having trouble keeping up with your bills, consider setting up automatic payments or payment reminders to help you stay on track. If you do miss a payment, try to pay it as soon as possible. The longer you wait, the more damage it can do to your credit score. If you have a history of late payments, it may take some time to improve your credit score. But by consistently paying your bills on time, you can gradually improve your payment history and boost your credit score. Keep your credit utilization low. Credit utilization is the amount of credit you are using compared to the amount of credit available to you. It's a good idea to keep your credit utilization below 30%. Credit utilization is a measure of how much credit you're using relative to your credit limit. For example, if you have a credit card with a $1,000 limit and you have a balance of $300, your credit utilization is 30%. Credit utilization accounts for about 30% of your credit score, so it's important to keep it in check. Experts generally recommend keeping your credit utilization below 30%. This means that if you have a credit card with a $1,000 limit, you should aim to keep your balance below $300. If you have multiple credit cards, it's a good idea to keep an eye on the utilization on each card as well as your overall utilization across all your cards. One way to keep your credit utilization low is to pay off your credit card balance in full each month. This way, you're not carrying a balance and your utilization will be 0%. If you're unable to pay off your balance in full each month, try to keep your utilization as low as possible. You can do this by paying more than the minimum payment or by transferring some of your balance to a card with a higher credit limit. By keeping your credit utilization low, you can help improve your credit score and show lenders that you're a responsible borrower. Check your credit report. Make sure to check your credit report regularly to ensure that all the information on it is accurate. If you find any errors, dispute them with the credit bureau. A credit report is a detailed record of your credit history. It includes information such as your credit accounts, payment history, and credit inquiries. It's important to check your credit report regularly to make sure all the information on it is accurate. Mistakes on your credit report can affect your credit score, so it's important to fix any errors as soon as possible. You're entitled to one free credit report from each of the 3 major credit bureaus, Equifax, Experian, and TransUnion, every year. You can request your credit reports for free at annualcreditreport.com. When you check your credit report, look for any mistakes or errors, such as accounts that don't belong to you, late payments that were actually made on time, or incorrect balances. If you find any errors, you can dispute them with the credit bureau. You can do this online, by phone, or by mail. The credit bureau will then investigate the dispute and make any necessary corrections to your credit report. Checking your credit report regularly can help you catch errors and disputes them before they have a chance to affect your credit score. It's a good idea to check your credit report at least once a year to make sure everything is accurate. Don't open too many credit accounts at once. Each time you apply for credit, it can have a negative impact on your credit score. So, try to avoid applying for too much credit at once. Don't close old credit cards. Closing old credit cards can actually have a negative impact on your credit score. It's better to keep them open and just use them sparingly. When you close a credit card, you're reducing the amount of credit available to you. This can increase your credit utilization, which is the amount of credit you're using relative to your credit limit. An increased credit utilization can have a negative impact on your credit score, as it may make you appear more reliant on credit. In addition to affecting your credit utilization, closing an old credit card can also shorten your credit history. Credit history accounts for about 15% of your credit score, so a shorter credit history can also lower your credit score. It's generally a good idea to keep old credit cards open, even if you're not using them. This can help maintain a longer credit history and lower your credit utilization. If you're not using an old credit card and you're worried about accidentally overspending on it, you can consider freezing the account or cutting up the card. This way, you can still keep the account open and maintain a longer credit history, but you won't be able to use the card. By keeping old credit cards open and using them sparingly, you can help maintain a good credit score and demonstrate to lenders that you're a responsible borrower. Now, let's talk about the importance of having a good credit score. A good credit score can open up a lot of doors for you, including getting approved for loans. Lenders are more likely to approve you for a loan if you have a good credit score. A good credit score can make it easier to get approved for a loan. Lenders use credit scores to evaluate your creditworthiness, which is a measure of your ability to pay back a loan on time. If you have a good credit score, lenders may view you as a lower risk and be more likely to approve your loan. You may also be offered a lower interest rate, which can save you money in the long run. On the other hand, if you have a low credit score, lenders may view you as a higher risk and be less likely to approve your loan or may offer you a higher interest rate. It's important to keep in mind that having a good credit score is just one factor that lenders consider when deciding whether to approve a loan. Other factors may include your income, employment history, and debt-to-income ratio. If you're planning to apply for a loan, it's a good idea to check your credit score and credit report beforehand to see where you stand. This can help you identify any areas that you may need to work on before applying for a loan. By improving your credit score and demonstrating to lenders that you're a responsible borrower, you can increase your chances of getting approved for a loan. Lower interest rates. If you have a good credit score, you may be offered lower interest rates on loans and credit cards, which can save you a lot of money in the long run. Renting an apartment. Landlords may check your credit score before renting an apartment to you. A good credit score may make you a more attractive tenant. Getting a good job. Some employers may check your credit score as part of the hiring process. A good credit score may give you an advantage over other candidates. In conclusion, a good credit score is important because it can help you get approved for loans, lower interest rates, rent an apartment, and even get a good job. Follow the steps we discussed to improve your credit score and make sure to keep it in good shape. Thanks for watching.